Capital follows profit, not patriotism. This is one of the most important yet least understood realities of the economic system we live under. Corporations do not make location decisions because they feel a deep love for the land, the people, or the flag. They do not stay in a country because they are grateful for the infrastructure built with taxpayer dollars, the legal systems that protect their contracts, or the subsidies they received in their early years. Their decisions are dictated by where they can maximize returns to shareholders, where they can cut costs, where they can secure advantages over their competitors, and where they can do so with the least resistance from governments and the public. The rest is window dressing, a public relations performance designed to mask the cold arithmetic behind every boardroom decision. In the United States, many of the tech companies that are now leaving once benefited enormously from public investments. The internet itself was a product of US government research funding. Public universities educated the engineers and scientists who would go on to build these companies. Tax breaks, grants, and infrastructure spending created the environment in which they thrived. These companies often marketed themselves as proudly American, draped themselves in the imagery of Silicon Valley innovation, and spoke endlessly about giving back to the country that nurtured them. But when conditions change, when another location offers higher profit margins, lower operational risks, or more favorable labor and tax structures, the sentimental slogans vanish. They leave, and they leave without looking back. This is not new. History is filled with examples of companies shifting production from one region to another, one country to another, and even one continent to another, chasing lower wages or lighter regulations. In manufacturing, jobs left the United States for Mexico, then from Mexico to China, and now increasingly from China to Southeast Asia. The pattern repeats across industries because the underlying motive is constant. Capital is in permanent search of more favorable conditions for accumulation. The logic applies just as much to tech firms as it did to textile factories a century ago. The tools and products are different, but the economic behavior is the same. What makes this moment particularly telling is that many people still believe tech companies were somehow different, that their dependence on a highly educated workforce, their integration into local communities, and their constant need for innovation would tie them more firmly to their birthplace. That illusion is now breaking. Canada offers a combination of predictable tax policies, attractive immigration rules, and social infrastructure that makes it easier to recruit and retain top talent. In purely financial terms, the calculations tip in Canada's favor. So the companies go. The national identity of these firms was always a marketing story. The real allegiance was and remains to the bottom line. This is why attempts to frame such moves as unpatriotic miss the point entirely. Patriotism assumes a mutual relationship, a shared identity between an individual or institution and a nation. But capital, as it functions under our current economic system, does not share that relationship. It is mobile by nature. It flows across borders as easily as water flows downhill, seeking the lowest resistance and the most profitable destination. It has no passport, no fixed homeland, no sense of national duty US. Corporate tax policy has long been a shifting landscape, subject to sudden changes depending on which political party controls Congress or the White House, and often shaped more by electoral calculations than by coherent long-term economic planning. For large corporations, especially those in the tech sector with global reach, this unpredictability is not a minor inconvenience. It is a risk factor that can affect billions of dollars in future earnings. A tax cut passed in one administration might be partially reversed or offset by new levies in the next. Promises of business friendly reform can turn into threats of higher rates or stricter enforcement when political winds shift. Even the mere anticipation of such changes can prompt corporate strategists to explore options elsewhere where the rules are clearer and the likelihood of sudden reversal is smaller. This instability is not purely about the numbers on a tax bill. It is also about how those numbers can change overnight due to political posturing. The U.S. has witnessed administrations use corporate tax policy as a bargaining chip in unrelated debates, from infrastructure funding to healthcare reform to deficit reduction. Such politicization of tax rules means that for businesses making multi-year investment plans, the domestic landscape can seem treacherous. A company might commit billions to expansion under one set of assumptions only to see the fiscal environment altered dramatically by the next election cycle. This volatility stands in contrast to places like Canada, where tax policy has been comparatively steady and where shifts in rates or deductions are more gradual, negotiated, and predictable. For technology firms, predictability is more than comfort, it is a competitive advantage. Product development cycles can span years, and major research investments may not yield profits for a decade. When tax laws change frequently or carry the threat of abrupt revision, the models used to forecast returns on those investments become less reliable. The uncertainty itself has a cost. Firms must spend more on tax consultants, lawyers, and lobbying efforts simply to navigate the shifting rules. This is money that could otherwise be directed toward research, innovation, or workforce development, but instead becomes a defensive expenditure to hedge against political instability. Moreover, the perception of risk in the U.S. tax environment is amplified by its highly polarized political climate. One administration might view tech companies as engines of growth to be supported, while another might cast them as monopolistic threats requiring regulation and higher taxes. The same company can be lauded in one year for its contributions to innovation and vilified the next for its market dominance or data practices. In such an environment, corporate leaders are incentivized to diversify their geographic footprint, placing major operations in jurisdictions where political attitudes toward business are less volatile. Canada offers a contrast that appeals to these executives. Its corporate tax structure is not only competitive, but has shown consistency over time, allowing companies to make long-term projections with greater confidence. The process of changing tax rates or introducing new business levies tends to involve broader consensus and longer implementation timelines, reducing the shock factor for corporate planners. This stability, paired with other favorable conditions, makes relocation or expansion into Canada appear less like a gamble and more like a rational, calculated move to secure predictable profitability over the long term. The treatment of tech workers in the United States reflects a broader pattern in which labor is regarded as a flexible cost to be minimized rather than a core resource to be protected and developed. In the U.S. system, Access to essential benefits such as health care is often tied to employment, creating a situation where losing a job can mean losing health coverage. For workers in an industry characterized by rapid technological change, periodic layoffs, and intense competition, this link between employment and healthcare adds a layer of insecurity that affects both recruitment and retention. For companies, it also translates into higher costs because providing private health insurance in the US is far more expensive than operating in countries with publicly funded systems. Canada's universal healthcare system alters this equation significantly. A Canadian tech worker does not depend on an employer for basic medical coverage, and an employer does not need to factor in the high cost of providing it. This reduces the total compensation expense per employee while still offering a standard of care that meets or exceeds what many U.S. workers receive. From a purely financial standpoint, it becomes more cost effective for a company to hire in Canada, especially when scaling up operations that require large numbers of highly skilled employees. The company saves money and the workers enjoy greater security, a rare alignment in a system that usually favors one at the expense of the other. Work-life balance is another critical factor. The U.S. tech industry is notorious for its long hours, always-on culture, and the expectation of constant availability, especially in high-stakes development cycles. While this intensity can yield short-term gains, it often results in burnout, turnover, and a decline in overall productivity over time. In contrast, Canadian labor regulations, cultural norms, and workplace expectations tend to be more favorable to maintaining a sustainable balance between work and personal life. Paid parental leave, vacation allowances, and protections against excessive overtime are more robust, and this makes Canadian tech jobs more attractive to skilled workers from around the world. Companies benefit because a healthier, more stable workforce reduces hiring churn and the costs associated with retraining. Recruitment strategies in the tech industry are global, and companies compete for top talent on an international scale. When the choice is between an offer in the United States with high out of pocket medical costs, fewer labor protections, and minimal paid time off, or an offer in Canada with universal health care, better social safety nets, and stronger worker protections, many candidates will see Canada as the more appealing option. This is especially true for workers with families or those who place a high value on personal stability. Companies recognize this preference and factor it into decisions about where to expand or relocate operations. In addition, Canadian cities like Toronto, Vancouver, and Montreal have become hubs of cultural diversity and global connectivity, making them attractive destinations for skilled workers from Europe, Asia, and Latin America. These cities offer both a high quality of life and a professional environment that encourages innovation without demanding the personal sacrifices that have become normalized in many U.S. tech hubs. The combination of lower costs for employers, stronger benefits for workers, and a more sustainable work culture shifts the competitive balance in Canada's favor, prompting companies to reconsider the assumption that the United States is the natural home for cutting-edge technological development. Immigration policy plays a decisive role in shaping the global competition for talent, particularly in industries like technology, where skilled labor is the primary driver of innovation and productivity. In the United States, the process of securing work visas for foreign talent has become increasingly cumbersome, unpredictable, and politically charged. Programs like the H-1B visa system are capped at numbers far below the demand from employers, and the lottery-based allocation means that even highly qualified candidates can be denied entry for reasons unrelated to their abilities or the needs of the company hiring them. Added to this are processing delays, frequent policy revisions, and the looming possibility that a change in administration could alter the rules entirely. For businesses trying to assemble world-class teams quickly, such uncertainty can disrupt project timelines and undermine strategic planning. Canada's approach to immigration, by contrast, is designed to attract and retain skilled workers in a systematic, deliberate way. Its points-based system evaluates applicants on criteria such as education, work experience, language proficiency, and age, creating a transparent process that allows companies to recruit internationally with confidence. When a Canadian tech firm or a multinational operating in Canada wants to hire a software engineer from India, a data scientist from Germany, or a robotics specialist from Brazil, the path is clearer, the requirements are well defined, and the outcome is more predictable. This reliability matters greatly in a field where technology evolves rapidly and delays in hiring can mean losing ground to competitors. The United States also faces a reputational challenge when it comes to attracting foreign talent. In recent years, high-profile political debates around immigration have often cast migrants in a negative light, creating a perception abroad that the country is less welcoming than it once was. Skilled workers weighing offers from multiple countries take into account not only the legal hurdles, but also the broader social climate they and their families might encounter. Canada has positioned itself as an open, multicultural society that values immigration as an economic strength, a stance that resonates with potential recruits from around the globe. Beyond the initial act of hiring, retention is another area where Canada's immigration framework offers advantages. Permanent residency pathways are integrated into the work visa system, meaning that highly skilled workers can transition more easily into long-term stability without the constant threat of visa expiration hanging over them. In the United States, even workers who have been in the country for years can find themselves in legal limbo, dependent on their employer's sponsorship and vulnerable to losing their status if they change jobs. This dynamic can deter top talent from committing to the U.S. job market when other countries offer greater security. For tech companies, the ability to source talent from anywhere in the world without bureaucratic bottlenecks is not simply a convenience. It is a competitive necessity. Emerging fields like artificial intelligence, quantum computing, and advanced robotics require expertise that is rare and globally dispersed. The jurisdiction that can assemble these skill sets fastest gains an edge in innovation, and Canada's immigration policy is structured to deliver that edge consistently. By contrast, the U.S. system often slows or blocks the very inflow of talent that its tech sector depends on, creating a self-imposed barrier to maintaining leadership in the global technology race. Infrastructure is one of the most underestimated yet critical factors in determining where high-value industries choose to locate their operations. In the technology sector, infrastructure extends far beyond roads and bridges. It includes high-speed internet connectivity, reliable power grids, efficient public transportation systems, modern office facilities, research institutions, and even urban planning that fosters collaboration and innovation. In the United States, despite its reputation as a global leader in technology, much of the underlying infrastructure that supports business has suffered from decades of underinvestment. Many regions, even those with a significant tech presence, face issues like outdated transportation systems, insufficient public transit, and broadband internet that fails to meet the demands of modern digital enterprises. These shortcomings create daily inefficiencies for workers and raise operational costs for companies. Canada, by contrast, has made significant investments in developing infrastructure that meets the needs of a modern, knowledge-based economy. Major cities such as Toronto, Vancouver, and Montreal have reliable high-speed internet coverage, not just in urban centers, but extending into suburban and even rural areas, making remote and hybrid work more viable. Public transportation systems, while not without their flaws, tend to be more integrated and better maintained than in many comparable U.S. cities, reducing commute times and improving quality of life for employees. This matters to companies not only because it makes their workforce more productive, but also because it makes recruitment easier. Talent is more willing to relocate to a city where basic infrastructure supports a high standard of living. The power grid is another area where reliability is critical. Data centers, research labs, and development hubs cannot afford frequent outages or voltage instability, as even brief disruptions can result in significant financial losses and compromised projects. Canada's energy infrastructure is generally stable, with a strong reliance on renewable sources such as hydroelectric power, which also allows companies to reduce their carbon footprint and meet environmental, social, and governance (ESG) goals without costly offsets. In contrast, parts of the United States have faced increasing grid instability, with blackouts, brownouts, and supply interruptions becoming more frequent in certain regions due to aging infrastructure and extreme weather events. Access to well-funded research institutions is another dimension of infrastructure that influences corporate decisions. Canadian universities and technical institutes often collaborate closely with private industry, providing not just a pipeline of skilled graduates, but also opportunities for joint research and development. Government programs frequently support these collaborations with grants, tax incentives, and innovation hubs that offer state-of-the-art facilities. In the U.S., while elite universities continue to produce top talent, the funding gap between well-known research centers and the rest of the educational system has widened, making consistent nationwide access to such resources more challenging. Urban planning also plays a role in shaping infrastructure's impact. Canadian cities have increasingly adopted designs that promote innovation clusters, where office space, co-working hubs, cultural amenities, and green spaces are integrated in ways that encourage interaction and idea exchange. These environments support the collaborative culture that drives much of the tech industry's creativity and problem solving. In many U.S. cities, by contrast, zoning restrictions, sprawl, and underfunded public amenities can create physical and social barriers that reduce the ease of such collaboration, making them less attractive to companies that depend on dense, interconnected professional networks. Capitalism as it operates in the modern global economy, is inherently transnational. It recognizes no permanent borders, no cultural boundaries, and no lasting loyalties to any one nation state. The fundamental logic driving it is the pursuit of profit, and this pursuit is unconstrained by considerations of national interest or civic duty. A corporation may begin its life in a particular country, benefiting from its infrastructure, workforce, and legal protections, but as soon as another location offers a better return on investment, it can and often will relocate its operations, supply chains, or headquarters without hesitation. This mobility is not a flaw in the system, it is one of its defining features embedded in its very design. For corporations, the decision to move operations is framed in terms of efficiency, competitiveness, and shareholder value. If taxes are lower in one jurisdiction, labor costs more predictable in another, and infrastructure more advanced in yet another, the rational strategy under capitalism is to shift resources to where they yield the highest returns. The calculations are done on spreadsheets, not on maps colored with national flags. Emotional or patriotic arguments rarely factor into these decisions because the system rewards financial optimization, not national loyalty. Executives are legally bound to prioritize the interests of shareholders, and this fiduciary obligation often means making choices that conflict with the economic interests of the country where the business was founded. This fluidity of capital creates a constant competition between nations to attract and retain investment. Governments offer tax incentives, regulatory exemptions, subsidies, and favorable trade agreements in an effort to lure corporations within their borders. These concessions can benefit companies in the short term, but may weaken the bargaining power of the state in the long run as corporations become accustomed to leveraging their mobility to extract further advantages. The result is a race to the bottom where public policy is increasingly shaped by the need to remain business friendly. In a global marketplace where capital can vanish with the click of a button. In the case of the technology sector, this dynamic is intensified by the fact that its core assets, intellectual property, data, and digital services, are highly portable. Unlike heavy industries that require massive physical plants and supply chains anchored to specific locations, tech companies can move large portions of their operations with relatively little disruption. Engineering teams can work remotely from different continents, servers can be relocated to data centers in other countries, and corporate headquarters can be shifted with minimal physical relocation. This agility makes them even less bound to the geography of their origins. Canada's rise as a destination for these companies illustrates how quickly the center of gravity can shift in a globalized economy. By offering a stable political climate, competitive corporate tax rates, favorable immigration policies, and robust infrastructure, Canada has positioned itself as a more attractive environment for certain sectors than the United States. For corporations whose guiding principle is to maximize returns while minimizing risk, such an environment represents not just an opportunity, but an imperative. The very same system that allowed them to thrive in the US enables and incentivizes them to leave when conditions elsewhere are more favorable without any structural mechanism compelling them to remain where they started.